Welcome to the Real Estate Syndication Show. Whether you are a seasoned investor or building a new real estate business, this is the show for you. Whitney Sewell talks to top experts in the business. Our goal is to help you master real estate syndication. And now your host, Whitney Sewell.
This is your daily real estate syndication show. I'm your host, Whitney Sewell. Today, our guest is Josh Cantwell. Thanks for being on the show, Josh.
Hey, Whitney, thanks so much for having me on. Glad we were able to finally get this scheduled up and go live. So thanks for having me.
Yeah, me too. I'm looking forward to this conversation. And a little about Josh. He's a true entrepreneur and prides himself in never having had a boss in his entire adult life. He had bought and sold over 700 properties in 25 states and has a portfolio of over 2,200 cash flowing apartments. He's the founder and CEO of Freeland Ventures, just one of his successful businesses where he manages over $30 million in private money. So Josh, I'm really looking forward to this conversation just from our talk even before we got started recording, but tell the listeners a little more about you and let's dive into this, to your personal story that I know is going to just hit everybody in a big way.
Yeah, Whitney, thanks so much for asking. I think like a lot of people, you kind of stumble into real estate one way or another. And my story is no different. I was a financial advisor coming out of college. My dad was an entrepreneur. He owned a employee benefits company. So he did, big packages of life insurance, disability insurance, medical insurance, and stuff like that for big companies. My dad put me through college and my brothers. And then when I came out of college, my dad was livid. He was so upset when I took an all commissioned position selling financial services. He's like, oh my God, I just spent hundreds of thousands of dollars on your education. Go get a real job making a salary. And what are you doing? I said, well, Dad, I've been watching you almost all my life. You started these businesses from nothing. I kind of want to be like you. So my first mentor was my dad. And to fast forward a few years, became really successful at financial planning. And I realized and saw that some of my most successful clients owned real estate. They didn't have all their money in the stock market with me in mutual funds and IRAs and life insurance. They owned restaurants, but they didn't own the restaurant. They owned the building and they rented it out to the restaurant. They owned single family. They owned multifamily. They flipped some properties on the side. They were all in real estate. I took notice, started going to some seminars, and in 2004, Cleveland, where I'm from, Whitney, was already in the middle of a foreclosure crisis. There were 10 publicly traded companies, big institutions like LTV Steel and Office Max and BP Oil that were leaving the city of Cleveland, and there was already a foreclosure crisis. So when I was marketing for motivated seller leads, everybody was calling me saying, hey, I'd love to sell my property, but it's only worth $150. And I owe $175. Can you help me? And I'm like, well, I've got to get good at something because all these leads are the same. And I took to foreclosure investing, pre-foreclosure investing, and short sale investing very, very quickly. And that was a good thing. But Whitney, we'll talk about this as we chat today. It was also kind of a bad thing because I got this kind of shiny object syndrome because we got really good at flipping properties. We got really good at wholesaling short sales, really good at foreclosure investing. And I lost sight of the real reason I got in real estate, which was cash flow, owning buildings, long-term legacy wealth, creating real income, because I became very transactional in my business. And so, but that was kind of how I got into it. That was my original start when I got going the first couple of years.
Wow. So it's neat though that you started out as a financial advisor and you immediately took note of, who your most successful clients were and how they got to where they were at. And then you're like, okay,
right.
I need to make a change here. And you did it. You became very good at short sales and foreclosure investing. But so you did that. And then you got into the transactional, over and over and over, right? And you got caught up into that. But then what happened? What changed?
Yeah, well, we became really good at it, Whitney. We got so good at it in 2004 and 5 and 6 and 7 that when the foreclosure crisis actually happened in 2007, 2008, we had already done like 300, 400, 500 short sales and pre-foreclosure deals and foreclosure deals. So now the rest of the country's like, oh crap, every house is in foreclosure. What do we do? And so people started asking us to speak and teach. And so I think it was July of 2007, 2008, we did our first live event, and I couldn't believe it. 150 people showed up to hear our story and what we were doing to monetize this foreclosure crisis. And we created software and we started hosting seminars and boot camps totally by accident. And then into 2010, 2011, we were one of the nation's leading educators and trainers on short sales and pre-foreclosure investing. And we did hundreds of deals that way, hundreds and hundreds. We even created a short sale negotiation service. We had a national contract with Homevestors, the residential franchise. We were negotiating deals for their franchisees. All this stuff's going great. And then by 2011, I was kind of, I wasn't excited about the business anymore. I was been so transactional for 6 or 7 years. I was really looking to make a change. And at that same exact time, I got the incredibly terrible news that I was gonna, I was diagnosed with pancreatic cancer. And so I think what happened was something I probably had wished had happened years before, where I actually could make a pivot, get out of what I was doing, get out of transactional real estate, get more into long-term legacy wealth and cash flow, but was so comfortable doing what I was doing, I never made that pivot, which was the reason why I really got into it in the first place. Cancer, being diagnosed with cancer and having this massive surgery forced me out of my business. It forced me to get away from the transactional business. It also forced my income to go like this, to go way down. And so I had to rethink what I was doing. And, that 8 months off forced me to take a step back and say, look, man, 7 years later, you've got a great income, but what do you really have to show for it? What have you built for the long term? So that experience of being diagnosed and surviving this massive surgery, and it forced me to kind of really think about, okay, let's go back to why we really got in this thing in the first place, right? And I think that happens for most of us, most of your listeners, most of my friends, my students, people, my clients I've worked with. There's kind of an epiphany, an abyss, a challenge, something that they go through that says, man, am I really living the life that I really want? Am I really doing what I set out to do? Is this really providing for my family? Is this really giving me the passion that I really set out to get? Or is this something I'm doing just because I'm comfortable? And so I went through that experience. It was amazing to step back and go through that sort of time to evaluate and think. Thank God I did, because that's really set me off on a whole new path to what we're doing today.
Yeah, I can't imagine though, when that first happened, you probably didn't have that view, or maybe you did, but on this whole scenario and what was taking place, and now seeing your business kind of going downhill, what really helped you through? I mean, that's such a difficult time. What helped you get through that to now to have the viewpoint that you do now? Yeah,
Whitney, thanks for asking. And frankly, it was my dad. My dad, he was an entrepreneur, and he, during that time when I was diagnosed, I remember he was there when I went to get my first biopsy. When I had this massive surgery, I was in the hospital for 10 days. They took out my stomach, my gallbladder, my spleen, most of my liver, most of my pancreas. I had to relearn how to eat. It was just an amazingly crazy surgery. It became a case study in the Cleveland Clinic that they studied. All their doctors studied this surgery, and the surgeon saved my life. But what actually was going on mentally was my father kept reinforcing to me, Josh, this is happening for a reason. Like, don't pay attention to the pain you're in. Don't pay attention to the physical pain. Don't pay attention to this incision that you have in your stomach, this massive incision. Pay attention to the journey. Like, this is happening for a reason. What are you going to learn along the way? He kept saying this to me. I remember pretty much every week. What have you learned? What are you thinking about? What have you learned this week that was different from last week? And part of it was, I took a lot of things for granted. I maybe took my wife and kids for granted, my time at home for granted. I was always at the office. And again, because I was so transactional, I was forced to be at the office. I started thinking about, from a business perspective, why did I really get into this thing? Like, what am I doing? This is not what I planned 7 years ago, Yeah. And so what happened actually, Whitney, was right before my surgery, I had raised a couple $100,000, about $150,000 of private money. We bought a couple properties. I hired general contractors to improve them. They did the work while I was out. And when I came back, and my surgery was in November of 11. When I came back in April 2012, I had flipped these two properties and made about $40,000 on each of them. and I flipped them. But the epiphany that I had was that funding, getting access to private capital, allowed me to have some freedom. It allowed me to have some more freedom of time, to have some more freedom of purpose and think, because I knew that these profits were coming, even though I had to stabilize these properties, renovate them. The funding gave me the opportunity to think about my future. Funding started to lead me down a path to freedom. And I started thinking, you know, owning the asset, whether it's a rental, whether it's a rehab, whether it's an apartment, owning the asset is really what I got in this 7 years ago. And I wanted to smash myself in the head because I had done it all wrong, but I at least recentered myself back to where I wanted to be. And I would tell your listeners and our audience, you know, how many of you have maybe a job, maybe you're a high paying executive or a high paid salesperson, or maybe you're not high paid, but you're in a job and you're only there because of comfort. It's not really where your passion's at. How many of you are maybe in residential real estate but want to be in commercial like where I'm at today? How many of you are flipping properties but prefer to own assets for cash flow? So, you know, by the time this is released, it's a great time to reflect on, like I did in 2011, 2012, are you really following your passion? Are you really following your goals? Because I was forced to rethink it. And that's what was going through my mind during this whole process. And my dad was really the epicenter of pushing me to think, almost like a mentor, almost like a coach. What are you learning through this process? What have you learned new? How are you going to do things different in the second half of your life? My dad tells me that all the time, Whitney. He says, Josh, you were spared for a reason. 35 years old, you had an 8% chance of survival. Pancreatic cancer has an 8% survival rate. You were spared for a reason. In the second half of your life, you know, what's the reason for that? You have to find out what the reasons were for that. So I'm thinking about that every single day.
Wow. Yeah, and I loved, you know, you said your dad mentioned, you know, pay attention to the journey. What are you going to learn along the way? It is. I mean, we all get so transactional, right? And we're just in the day to day, and we all have this big goal in mind, but we forget today. We forget about the journey. And
right.
I know so many of the listeners can relate to your story so well. And, you know, but then you made the big change. You know, you left the transactional, you got back into the cash flow, you moved into apartments. Tell me about that transition a little bit and moving into the apartment space now.
Again, almost by accident. What happened is that I initially moved from raising private money to managing private money. We started a private equity fund in 2014, 2015. We took dollars into that fund. We created our first big private placement, 506B. We started recruiting capital. That grew pretty quickly. And we were essentially making private lender loans. So instead of getting into apartments right away, we went into the syndication private equity world of PPMs on the lending space. We were making private money loans and hard money loans for residential and commercial properties, first mortgage debt. And I was able to move out of being transactional and being the operator to being more of the money manager and making the loans that were creating passive income for me and for my companies. Then what happened, fast forward a few more years, those investors were really happy with their returns. And they started saying, you know, hey, Josh, this is great. Your fund is awesome. I've got, 200,000, I've got 400,000, I've got 50,000 in that fund, but I've got more money. What else do you have? Like, what else can I do with you besides this fund? And I had some friends that were in the apartment world that were already successful, kind of small balance apartment investors. They maybe owned 15 units, 25 units, 35 units, and they were leveling up their game. And of course, they needed access to more money. And I had relationships with these guys for years. And so I went to them and I said, look, I've got investors that got more capital. You guys are looking to level up your multifamily game. Why don't we joint venture on some more deals? I can underwrite them. We've been an underwriter forever. We've been a private lender forever. Can help you underwrite deals. I can give you some more credibility because you can go to brokers and off-market properties and pocket listings and say, look, I've got all this capital behind me. We know how to operate smaller buildings. Let's go buy some bigger ones. So we did that. I partnered up with a couple friends of mine. We went and made offers on some bigger properties. And sure enough, the first big one we landed was a 730 unit. 730 unit. Massive.
You didn't waste any time.
Not waste any time. Massive lift, a 730 unit. My friend Tim Bratz, who many people know, who's in the in the syndication game. It was his really first big deal. I was a big part of that team that put that deal together and took that deal down. $10 million purchase, $10 million of renovations. We had to raise about $6 million, which we did. And that portfolio now has been almost completely renovated, stabilized. It's operating at like 85, 90, 95% occupancy, depending on which building. And we're going to be refinancing that massive portfolio in 2020. We'll be all in for about $24 million. And based on about a 6.5 cap, it's going to appraise out at $48 million. And so it was a massive deal. And then we just went and like, okay, well, that worked. And I'm really good at money. I'm really good at underwriting. I'm really good at due diligence. I'm really good at investor relationships and capital management. I knew that could be my place. So I continued to go to other operators and friends of mine, a joint venture with them, because I knew my role, Whitney. I knew I wasn't I knew I couldn't do a $10 million rehab. I knew I wasn't the GP that was also the project manager or the general contractor who was going to do $1 million lift or a $500,000 lift. I knew my role. So, in an apartment deal, there's 6, 7, 8 spots you can sit. It's a big joint venture, as you know. So I knew what I could do well. I knew I could partner with guys who could do other things well. And we've done now 7 or 8 massive projects. It's a $200 million portfolio. We've got about $10 or $12 million of our capital in those apartment deals. And we've just taken down deal after deal after deal after deal after that. So it was really by accident. And we're excited. We do a lot of value add stuff. So we're not buying a lot of apartments that are really stable right now. We're buying stuff that maybe has a little bit more vacancy, where there's a little bit of opportunity to do some lease turns, increase the rents, and then refinance into permanent financing.
Nice. So sounds like you had a really good skill. I mean, you were really good at raising money. You had all these great connections. And then, this other industry over here, or I mean, still in real estate, but this other type of real estate business where they need that type of skill in a big way, which we do in the syndication business.
Sure.
And I mean, that's a perfect fit. So you created massive value to this team, with your skill set and the connections that you had built over many years.
Yeah, Whitney, I think the point here, and I would, again, talking to our listeners, you don't have to be an expert at everything, right? Like niche is rich. So knowing your niche, knowing what you're good at, and then aligning yourself at, going to different multifamily events, meetups, seminars, being on podcasts, participating in Facebook groups where there's other operators, building relationships, getting to know people. You realize some good guys are really good at finding deal flow, but they're not great operators. Other guys are great operators that actually like boots on the ground at the job site every single day. Some guys are good at that. Some guys are good at raising money, investor relations, due diligence, securities work, capital management. So it's really like there's very few guys in this space, Whitney, as you know, that do it all, right? They find the deal, they operate the deal, they raise all the money, they sign the personal guarantee. Very few guys do it all. So it's really about, finding your niche, and finding guys you like to be around, finding guys you like to do deals with, or girls that you like to do deals with, because it is a long-term relationship, right? You get a deal, hopefully you're in that deal for a very long time, and it's very profitable. So it's going to be a partnership. You're going to get married for a while. Married for a while, that's kind of a weird term, but married in that apartment deal. So you're going to be together for a long time. So you got to be doing deals with people that you like and people that can contribute.
I couldn't agree with you more. I mean, I definitely couldn't have gotten where I'm at doing it by myself. And I would say people who are doing it by themselves are really holding themselves back.
Sure.
There's just no way. I couldn't imagine doing all these pieces by myself. I mean, we've done this only by building a team and hiring professionals to partner with, that are much better at parts of this puzzle than I'll probably ever be,
Right.
So,
yeah. And finding guys, when I got involved in that first deal, I looked back at their experience and said, well, what other deals have you done? Show me like other apartments that you've done. And you've taken this model from A to Z, from acquisition to stabilization to operation to exit or refi. And they were able to show me some proof. And so I saw that over the couple of years. And then I'm like, okay, now here's the deal that makes a lot of sense. Let's jump in and let's make this go. And then, we close that big 730 unit. Then we close a 407. Then a 200, then a 216, then a 492, then a 164, and the things just mushroomed out in the past 2 years or so. Again, because we've got guys that are really good at acquisition. We've got other guys good at operations, other guys really good at securities work or underwriting, other guys good at raising money. And we put together a nice team. And so I still feel like we're just kind of scratching the surface. This next 5 years, I know the market's hot. I know the cap rates are really low. But if you find stuff at a value, find stuff underpriced, which is the goal, you got to dig through a lot to find one or two good deals. But if you can do that, you hold on to the asset for the long term. And now I can make up for the first 7 years when I screwed the whole thing up, right?
Are you strictly focused on the syndication and distressed apartments now?
Well, I would say we're still in a sort of a pivot. I say half pregnant, if you will, because we still have about $20 million in our fund that is all in both residential and commercial loans, private money and hard money loans. So we are making a lot of loans. We're also an approved originator for several crowdfunding platforms. So we originate small balance and middle market multifamily paper. We fund first mortgage debt, and then we sell that to these crowdfunding platforms, and then they sell that paper off to their investor base. So we're pivoting to get more and more of those dollars away from resi and more into multifamily. But we've got 10, 15 million in commercial multifamily. We're originating paper for multifamily, but we've still got about 20 million still in the resi space that's going to migrate over the next year or two.
Moving from the transactional space, whether it's wholesaling or or flipping, whatever it may be, to the syndication business. I know there's a lot of listeners who are in that same boat now, or they're trying to get into the syndication business. Maybe you could just speak a couple things to them that everybody that comes up and says, Josh, what do I need to do to get in the syndication business? I've been flipping homes or wholesaling. What would you tell them?
Well, my first piece of advice, Whitney, is a great question, because this is exactly what I lived in 2011 and 12, which is you may have to resolve yourself and make up your mind that you're going to make less money for the next year or two. If you're flipping less properties, you may have less transactional income for the next year or two. But if you're going to get in the syndication business and own apartments long term, you're going to have so much more over the next 5, 10, 20 years, that little maybe step, what might feel like a step back, or that dip down in personal income over the next 12 to 24 months, that's what I went through. And I was cool with that because I knew I was now investing for the right reasons and the right thing. So it's okay. It's okay to take a step back. It's okay if you know that you're realigning yourself with what your true long-term goals are, of creating permanent cash flow, providing for your kids and your grandkids. And just, getting into commercial is fun. It's more risk, but if you do it the right way, you can manage risk really well. And so it's not necessarily riskier as long as you manage the risk well and underwrite properly. But that's the first thing, is just saying, it's okay. It's okay if I go backwards. It's okay if I'm less transactional, because I know it's going to take some time to ramp. The second thing I would say is, start meeting with investors now, showing them potential deals that you don't even have under contract, what a deal could look like. Are you going to pay a preferred return with some equity? Is there a refinance opportunity to return some of the equity or all the equity? Start to present those types of deals to people. And I swear people are going to be so interested, you're going to build up this little war chest of potential investors, so that when you get it, you knock down a 100 unit or a 50 unit or a 200 unit or whatever, these people are already primed and kind of waiting for that deal. So those two things, right? It's okay mentally to know that you're going to, might take a step back. It's okay if you're investing for the long term. And secondly is just start presenting what could be potential deal flow or potential investor structures, and just say, hey, I don't have a deal yet. This is not an offer of a security. I'm just letting you know that this is the way I probably structure it when I do a deal. These are some structures I've seen from my buddies, my joint venture partners, people at seminars. They've structured them this way. So if I found a deal and it was structured like this, how interested would you be in something like that? Or what I like to do is to present something to Whitney and say, hey, I'm not assuming that you're interested at all, but if you know anyone that would be interested in this or interested in learning more, can you refer me? Can you keep me as a top of mind reference? And then they'll say the magic words, what about me? Okay. I love that. I never really present to somebody and ask them for money. I present the concept and then tell them, hey, I'm not assuming you're interested at all. I'm not assuming you're liquid or have any money, but thank you for taking this appointment with me. Thank you for taking the time. If you know anybody, just introduce them to me. I'd love to build my network. And then again, the 3 words we're waiting for is what about me, which happens all the time because we didn't pressure anybody into, investing with us.
Wow. No, that's awesome, Josh. I appreciate you sharing that. And for the listeners, Josh has this 12-step process of raising capital that we're planning to have him back on the show and let's go through. It may take a couple shows, but I'm really looking forward to that, Josh. And unfortunately, we're about out of time today. But just a few more questions. But also, I know the listeners can really relate to your story, and I appreciate you sharing that and being so open and being willing to help others by using your story as well. But Josh, what's been the hardest part of this syndication journey for you?
I don't think there's anything that's really been hard about it. It's just you don't know what you don't know. And so we're all going to fail. So you can either fail fast or fail slow. I listened to a great podcast once, and there's this one-liner that I heard really resonated with me. It was, you can create and achieve all your goals in 10 years if you kind of do it part-time on the side. You can have your day job or your transactional thing and also do what you're really passionate for, in my case, which is apartment syndication. And you could do that part-time, and that could take you 10 years. Or you could jump in full-time and know that you're going to fail, know that you don't know it all, but go full speed and accomplish those same goals in 3 years. So you can do them, but do you want to do them in 3 years or 10? That resonated for me because when I was, again, and I still sort of feel like I'm half pregnant with residential, moving to commercial. If I continue to do both, that's hard. That's hard to do both. What's actually going to be easier is just committing 100% to syndication, multifamily. So what I tell people now is we lend on, we joint venture on, and we buy and operate multifamily properties. That's all we do. So what's hard about it is just, again, every day finding something new to learn, every day making another contact, knowing that it's long-term gratification instead of a short-term really fast win, because there's always the temptation of falling back to instant gratification, right? The syndication and multifamily game is a long-term wealth building, huge gratification game. It's not instant gratification. That's the hardest part about it.
Couldn't agree more. Oh, well said. And how do you prepare for this potential downturn that everybody's talking about?
Yeah, I think it's a couple things. I think it's making sure that you're underwriting deals really, really conservatively. If you think you can get, $200 rent bumps, maybe underwrite them at a $75 rent bump. If you think that you're going to get a 6 cap, on stabilization and maybe refinance or sale, maybe run your numbers at a 6.5 or a 7 cap. So you're not running your pro formas at all at, best case scenarios. Instead of, underwriting the deal and saying, I'm going to get financing at 4%, which, we've seen deals, we've been able to secure long-term permanent financing at 3.8%. It's so low the cost of money. We underwrite them at a 5% interest rate. So that's a big part of it. Second thing is knowing that we have to have enough capital, right? The only way you really lose money in this big downturn that people are potentially talking about is if you run out of cash, right? Ray Dalio talked about it in his book, his principles book about, I want to have enough cash that I never get knocked out of the game. So having a little bit extra in reserves, maybe over raising maybe a couple $100 extra $1,000, keeping it in a reserve account, making sure investors know, hey, if we're planning on refinancing, maybe it might take an extra year or two. Stay with me. The only time we really lose here is if we sell in the downturn. If we hold, just like in 2007, if you bought an apartment building in 2007, by 2017, that full value came all the way back plus more, right? So again, if you buy it now, and even if you're buying at the top of the market, just don't sell 3 years from now if we're in the middle of a downturn. Make sure you can hold on to that thing for the next 10 years because that value will come back. We just proved that in the worst economic downturn in our lifetime from 2007 through 2010. And then, 10 years later, you had more than your value back in those residential and apartment deals. So underwrite conservatively, overraise capital, be prepared to hold for the long term, don't sell in a downturn. Those are some of the things that we're preparing for.
That makes me, we don't have a lot of time to go in depth in this, but I wonder what kind of debt will you put on distressed property right now?
Yeah. So when we can get permanent financing, we're trying to do that out of the gate, but we're still trying to buy properties where we can get a lift. So we closed a deal about 6 months ago. We're able to get permanent financing out of the gate, but we convinced the lender. So this is a 492 unit. Permanent financing out of the gate, 12-year balloon, 30-year AM type of stuff. And we're able to convince them out of the gate, permanent financing 3.8%, but also able to convince them and said, look, there's a lift here. We're going to get a substantial larger value when we're done with the renovations and the rent bumps. And they agreed to in advance that if we can get that value, that they would comfortably slap a supplemental loan on it behind it. So essentially like a refi, but without refinancing that first mortgage. So essentially like a refi, slapping a second mortgage on it so that we can get all of our investor capital out of it and even pull some cash out refi proceeds out of it. That's an ideal deal in today's market because you're not doing a bridge loan where there's the chance to have that balloon called or that note mature and then have to sell the asset at the wrong time. Now we are doing some bridge loan debt still, but only on stuff where there's enough of a value add lift that we can refi in the next 1 to 3 years. Because even if there's a downturn, there's so much money in the market right now. We don't anticipate that money just drying up overnight. Rates might go up, cap rates might go up a little bit, but if we're buying them at a good enough price, there's an opportunity to still do some bridge financing for 2 to 3 years, stabilize the asset, and then refi. And that's what we're doing with some value add stuff. But ideally, we get permanent financing with the opportunity to do a sup loan when the value's there, and then pull some investor capital back out or some cash out refi proceeds. That's
nice.
Ideal if you can do it.
Yeah, I appreciate you explaining that. And what's a way you have recently improved your business that we could apply to ours?
Yeah, it's a great question, Whitney. Wow, what a great question. And I think it really starts with the owner, operator, CEO. And this is something I've gotten right this year that I didn't have right, 2-3 years ago. My morning routine personally sets the table not only for my business, but also for my entire organization. My personal routine, I've realized, is the pivot point. It's the epicenter. And I don't say that to brag or take too much ownership of the business, but I just feel like if I get my morning right, the business operates at a higher level. I operate at a higher level. So my routine looks like this. I'm up at about 5:45, get my kids up at 6:15. We're out the door. I drive them to school every day. 7:10, we're out the door. I drive them to school. And it's awesome, Whitney. I don't know if you have kids, but my kids are 11, 10, and 8. And they tell me stuff in the car in the morning that we don't tell their friends. We don't talk about. They'll just little stuff. You're like about a teacher or about a classmate or about school or about a dance that they're going to. My 11-year-old daughter's, going to dances. There's boys there. So little stuff like that. But then I go to the gym and I don't work out for an hour. I don't have an hour. But if I can work out for 20 minutes and so drop my kids off at 7:30, I've got till 8:20. I know my schedule is 8:20. I'm out of the gym and I'm in the shower and then I'm out of my gym at 8:35. So I've got the time. Some days I swim. Some days it's weights. Some days it's cardio. But that morning is so key for me because if I can do that 4 days a week, which is my goal, sometimes I even get 5 days a week. Sometimes it's 3. But then when I get to the office, around 9. So I'm not here at 7:30. I'm not here at 8. A lot of people beat me here. But my mind, I've had the time to think while I was at the gym. My mind is totally now dialed into exactly what's going on with my day, my week, our priorities, our mission. I arrive, I'm on fire, I'm ready to go. Then I have my sales meeting with my acquisitions manager, my business development guys at 9:30. That's working really well because it sets them up. We talk about dials they made, brokers they called, deals we're trying to lend on, deals we're trying to buy right out of the gate. Then by 10 o'clock, everybody's on the phone, right? We're rolling, man. It really starts though with me, like a year ago, 2 years ago, I didn't have that whole system down. And without it, the office was kind of like, well, what are we doing? Like, are we having a meeting or not? When is Josh going to get to the office? You know? And now, like, we know. Now we know when we're on the phone. We know what metrics we've got to hit as a sales organization, how many brokers we've got to call. And then on certain days, I have my operational meetings to talk about KPIs and things like that. I do that on Monday afternoon. So, but that morning for me has been huge, Whitney. If I get that right, everything else just seems to work.
Nice. And what's a way that you like to give back?
Well, great question. I personally, this time of year at Christmas time is huge. We sponsor lots of organizations and agencies. But, everybody likes to do that around the holidays, Christmas time. I think for me, giving back a lot is, we have, a coaching organization. We have people that pay us lots and lots of money to coach them. But what I really love to do is usually once a month, a couple times a quarter, a couple times a month, just having a call with a new investor that's really just getting going and talking to them for 15, 20 minutes, 30 minutes and coaching them for free, right? I usually get so much joy out of that because I can relate to not only when I started in 2004, but then when I went through my cancer scare in 2011, and then even pivoting again into commercial is almost like a reboot again, right? So I understand what it's like to restart a couple times and to tell that story and kind of give back to them and, not, be staring at the clock and trying to, hustle them off the phone, having a lunch meeting with a newer investor, just to, tell them my story and help them understand, like, you can do it, right? We all started at zero. That's one of my favorite ways to really to have an impact on one person, as opposed to just giving money or those kind of things, but to touch with one person, to have a real connection with them on a monthly basis on the phone or face to face, and feel like they're going to remember me and I'm going to remember that meeting.
Yeah, I would say you're giving something of a lot more value by giving your time that way and sharing with them, giving some guidance, as opposed if you were just handing somebody some money.
Yeah.
So, thanks for sharing that, Josh. An amazing story. And I can't wait to have you back on and us talk about your 12 steps of raising capital. I know the listeners will really look forward to that as well. But tell them how they can get in touch with you and learn more about you.
Sure. So our main website is freelandventures.com. They can go there. They can see some of the deals that we work on and all the other things we do. Links to our book, links to our podcast, links to our lending site. So if they're looking to borrow money, pick up our book, which they can get for free, just pay the shipping, our podcast, all of that starts at freelandventures.com.
Thank you for listening to the Real Estate Syndication Show, brought to you by Life Bridge Capital. Life Bridge Capital works with investors nationwide to invest in real estate, while also donating 50% of its profits to assist parents who are committing to adoption. Life Bridge Capital, making a difference, one investor and one child at a time. Connect online at www.lifebridgecapital.com for free material and videos to further your success.